Today, Governor Lowe and the Reserve Board met and they kept the cash rate on hold for a 21st consecutive month. So we haven't seen an adjustment to the cash rate since August of 2016. So let's take a look at what's happening, in the positive side of the economy. Firstly, let's look at business confidence. So business confidence is sitting really high at the moment, and the forward projections and outlook for that is also very, very positive. Now that's resulting in business investment in the non-mining sector. So it basically means all of those businesses that we wanted to be investing into their business, because investment also means jobs. Also globally, we're seeing the overall global economy moving quite well. We did see a little bit of dark clouds forming around trade wars, but we're starting to see some of those pressures start to ease off a little bit. And I think that is sensible. And then we look, generally speaking, around unemployment or employment itself sitting around 5.5%. So broadly speaking, that's pretty good. So they're the positive news stories around how the economy is moving forward. But that's not enough for the RBA to be moving the cash rate. In fact, we still have challenges in the economy around our inflation, still not high enough, still not in that 2 to 3% range that the RBA is looking for to give them some confidence to move on the cash rate. We also see the correction in the property market. So we're starting to see property prices in Sydney and Melbourne starting to flatten, and so lower growth and in some cases some declines in some markets as well. Now, we're also seeing the credit squeeze happening where we're seeing, obviously APRA's macro-prudential stuff is still biting. We're seeing tightening credit policy, which means that borrowers aren't being able to access credit at that sort of retail consumer level as easily as we have in the past. So they are also still reasons why the economy is not moving, because we then correlate that to consumer confidence, and consumer confidence, retail spending is sluggish at best. Still some positive numbers there, but still not giving us enough confidence to move the cash rate. So that's the reason why the Reserve Bank has kept the cash rate on hold. Now, I want to sort of take, a little bit of a riskier step and speak outside of what maybe a lot of people are talking about at the moment, and that is cost of funding. So, I'm taking an early call on this, but there's a few things that are happening around cost of funding, which is going to put pressure on banks passing on some of those costs to consumers. And what I'm talking about here is, firstly, the 10-year US bond yield. That has moved above 3% for the first time in over 3 years. Now that has been a combination of a couple of things. Rising interest rates in the US, but also potentially these trade wars that we saw between the US and China. Again, I mentioned earlier they are starting to cool down a little bit, but that has pushed the bond yield high. Now what does that mean? That basically means that wholesale funds that we might get offshore. Now in Australia we get around 70% of our funds domestically through deposits, and then we on-lend that through the banks. But some of those wholesale funds for our second tier lenders is going to come from offshore. Now if those cost of funds are getting higher, that obviously means that what the banks buy their money for and what they lend it out, that's their margin, and that could be squeezing that margin. Now no right banker in their right mind is right in the middle of this sort of Royal Commission are going to do an out of cycle rate rise. It would just be, PR suicide, brand damage would be terrible. But it is going to happen at some point into the future where those costs of funds are going to bite into margins. In addition to that, we've seen some of the shocking revelations around the Royal Commission, and that is going to cause obviously greater compliance for banks. There's also maybe provisioning for fines that may be imposed on some of these breaches that we've also seen. And then we're also seeing early stages of class actions against some of those banks in regards to some of their practices. So that is all a big cost. Now ultimately the bank is going to have to fund that money. Now their shareholders are obviously very disappointed about that, and the shareholders are going to want to see a return at some point into the future. So with all of this pressure that comes from something like a Royal Commission, ultimately someone has to pay. Now whether that's going to be the shareholder, whether it's going to be the wages inside the bank, or ultimately whether it's going to be a consumer, one's going to argue that it's going to be all three of those things. But make no mistake, the cost of money is going to get higher, and that's going to be passed on to consumers. And that's why here at Empower Wealth we've always talked about making sure you set your cash flow models to a long-term interest rate, not this very, very low interest rate environment that we're in at the moment. So 7.25% has always been our benchmark in terms of making sure you can afford the lending that you're engaging in terms of your wealth creation strategies. So just keep that in mind. Make sure you're also building that war chest and that buffer up. Make sure you've got that offset account working for you and you've got your living and lifestyle and you're using the Money Smart system. If you want to learn more about the Money Smart system and download our little fact sheet, just click on the link below because that will give you more information around that. But this is a changing environment. So even though cash rate may be on hold for the longer term, there's no doubt that there's going to be some minutiae around the cost of funding, and that's ultimately going to hit the retail borrower, certainly the business borrower, into the future. Thanks for watching.